Hi everybody, let's in this video consider different ways in which competition authorities can regulate monopolies to promote more competitive outcomes and to protect the public interest. Well, let's get going straight away by looking at maybe the most common approach, which is price regulation. Now, often you see with price regulation, prices not allowed to be increased the next year beyond RPI. Remember, RPI is the rate of inflation, it's a measure of inflation. And that would be, I guess, a fair way to restrict price increases for a firm. I mean, if you're a firm and your costs are increasing by RPI, because that is the level of inflation, everybody's increasing their prices by RPI, let's say, then for you as a firm to also increase your prices by RPI is a fair thing to do. You will therefore be covering your costs. So RPI inflation, you could argue, is a relatively fair price control to be set. Going more strict, though, is the idea of RPI minus X price regulation. And we see this with airport charges, for example, in the UK. The idea of RPI minus X is to restrict the level by which firms can increase their prices below RPI, where X represents a percentage. So maybe if RPI is 3% and X is 1%, then prices next year can only rise by 2% for a given firm. The idea behind this is to promote the incentives of efficiency saving. The regulator basically is saying, look guys, you don't need an RPI increase in price. If you're efficient and you cut costs, then actually you can increase prices by lower than that and still make a decent profit for you to invest back into your company. So that's the idea behind this. And if you're a company, your incentive is to cut costs as much as possible below X. Why? Because then you can raise your prices by RPI minus X, but actually you've cut costs more, which gives you a greater profit margin. So strong incentives of RPI minus X. But you also might have RPI plus or minus K. We see this a lot in the water industry in the UK, where K represents a percentage whereby enough profits can be made to allow for capital investment. So if K needs to be greater than RPI, so a percentage which is positive, so a price increase of RPI plus K, or if K is negative, whereby prices don't need to rise above RPI. They can rise below RPI, giving enough profit for firms to make to allow for capital investment. But if it's RPI plus K, the idea is that RPI price increases on their own won't generate a high enough profit to sustain big capital investments in a company. The rationale of price regulation is to do what this diagram says. So you see on this diagram, I've shown monopoly outcomes at PM and QM. But effective price regulation essentially is to set maximum prices at the allocatively efficient level, at the competitive level, which is PC and QC. The end result of that would be, of course, lower prices, higher quantities, competitive outcomes being generated. So drawing this diagram in an essay, essentially having a maximum price, a price ceiling in this case, where prices can't go above this, is the intention of price regulation. Feel free to draw that in your essay. Let's now look at problems with such price regulation. Well, information issues. How is the level of X or the level of K going to be generated? Well, the idea here, in theory, is that governments or regulatory bodies will have perfect information. They'll investigate companies, they'll work out costs and revenues, and they'll therefore appropriately decide on the level of X or K that is required. But there is not perfect information. Just because these regulators go into businesses, it doesn't mean they're going to get the perfect information to get this level right. If the level of X is set too harshly, i.e. it's set very, very high, then it might actually cripple firms. It may lead to firms shutting down or not making enough profit to sustain their operation. That's not the idea. If X is set too low, then you might not get the competitive outcomes that this regulation is supposed to promote. If K is set too high, then again, you might get outcomes that are not competitive. If K is set too low, you might not get the level of profits being made to sustain capital investment. At the same time, for regulatory bodies to go into firms and investigate is very, very costly and time consuming. The taxpayer has to bear that cost. There is a significant opportunity cost, you might argue, to this, especially if the level of X and K is set wrong anyway, and the price regulation is not effective in doing what it's supposed to do. You might, as a firm, argue that, whoa, if a regulatory body is setting RPI minus X as regulation, and we are successful in finding efficiency savings, in cutting costs, then the incentive for the regulatory body is always to keep reducing X, even though we have been really successful. That's the incentive. So if we meet RPI minus X and we do better than RPI minus X and we're making good profits because we've cut costs lower, then next year, who knows, the regulatory body might reduce X, and that's just not fair on us. And also there is a risk of regulatory capture. Now think about it, the best regulators will be those who have previously worked in the industry in question. And therefore they might have very good contacts of managers and owners of companies who still exist in that industry. And therefore the incentive is for those owners, for those managers to get in touch with the regulator and to maybe make the regulations less strict, to reduce the extent of the regulation. The problem with that is that the regulation doesn't do its job, and regulations in place do not promote competitive outcomes. Monopoly outcomes may still result. That is known as regulatory capture, where basically the owners and the managers, those who work in the industry, become good friends with the regulators and stop regulation being strict enough to promote competitive outcomes. This is a big source of government failure. What's another kind of regulation we might see? Well, quality control or performance targets. We see these things in the UK with trains, for example, the number of delays that train companies are allowed to have on a daily basis. In gas and electricity markets, so for OAPs, for pensioners, if they get into financial trouble in the winter and they can't pay their gas or electricity bills, then the companies are not allowed to cut their gas or electricity supply. And the NHS, there are performance targets such as GPs seeing a set number of patients in a given hour, and for emergency services to react to emergency calls in 8 minutes or less, so for ambulances to reach emergency calls in 8 minutes or less. The problem with performance targets and quality controls is that it could lead to unintended consequences. So if we take the NHS performance targets, for example, GPs seeing a set number of patients in a given hour may lead to GPs not diagnosing appropriately, taking shortcuts in their appointments instead of doing things thoroughly. And also you might see companies gaming the system. So we take train companies, for example. If they're only allowed a certain number of delays in a given day, what they might do is extend journey times and say journey times are going to take longer than what they otherwise should to prevent delays taking place daily. Another kind of regulation could be profit control or profit regulation, using the equation whereby costs are going to be covered, but also adding a percentage rate of return on capital employed. We know that capital employed, our investment, is a risky thing to do. It's very high cost, but the idea is that, okay, there is a cost in the short term, but long term, through higher productivity and greater production, there is going to be greater profit that is going to be given as a result of this investment in capital. So regulatory authorities might say, right, if you employ capital, we'll give you a rate of return on capital to reflect the greater profits that this machine is going to give you in the future. The problem with regulating profit, let's say at a competitive level, is that there is asymmetric information. Of course there is going to be asymmetric information. If you're a monopolist, what are you going to do? You're going to over-report your costs, and you're going to over-report your capital employed, and you're going to over-report your costs, aren't you? To make sure that the level of regulated profit is going to be higher, which gives you a higher level of profit to work with. But also, if you think about it, there is an incentive for monopolists to let their costs go out of control, because they're always going to be covered. And there is also an incentive for monopolists to over-employ capital, to keep investing and buying in new capital machinery, because each machine is going to increase the rate of return equation, which is therefore going to increase the level of profit that monopolists are allowed to make. So maybe a nice idea in theory, but in reality quite a stupid idea, given the distortion of incentives that are promoted with this. You might argue that taxing monopoly profits is a good idea here, so windfall taxes on monopoly profit. But if we go to this diagram up here, what is that going to do? Well, it's going to increase the cost of production for monopolists, shifting the marginal cost curve upwards. All that's going to do is to increase prices further, greater than PM, and to reduce quantities further, less than QM. So it's only going to make monopoly outcomes worse. That's not a good thing. At the same time, you promote tax evasion and tax avoidance by the monopolist. Linked to that is number 4, which is a monopolist underreporting the level of profit, right, to avoid or to evade paying taxes. And that's not a good thing. That could reduce the whole idea and make this policy not very effective. And also, the risk of less innovation and less dynamic efficiency. If monopolists are doing what they should be doing, or what is in the public interest with profits, are you reinvesting them back into the company, into new products, into new technology, into innovation and R&D, then that's a good thing. By taxing profits, you are taking away the potential for monopolists to do that. You've also got merger policy, so if ever there is a merger between companies that creates a market share greater than 25%, competition authorities could investigate, and they could do two things. They could either break up the merger if the merger goes heavily against the public interest, or what the competition authority could do is if that merger creates monopoly outcomes in certain locations, then in those locations they could force this new merger to sell off stores or outlets in those locations to competitors to promote more competitive outcomes in those locations. So that is a very common type of merger policy as well, selling off stores and outlets in areas where competition might be distorted and monopoly outcomes might be the result. We've also got policies like number 6, number 7 and number 8, privatisation, deregulation and reducing trade barriers. The idea for all of these three policies is that competition will be promoted. So these are market liberalising policies to promote competition and therefore competitive outcomes. I have made separate videos on each of these three different policies for you to look at. So I'm not going to cover these three in detail in this video. The links to the videos are in the description box below and links flying above me as well for you to click on. So do look at these three policies to look at how they work in theory in promoting competition, but also looking at the problems with these policies in isolation too. So that gives you a plethora of policies to consider of competition authorities like the CMA enacting competition policies to protect the public interest and to promote competitive outcomes. So plenty for you to discuss in an essay. Let's now look at evaluation points for you to come to a judgment in answering a question over whether monopoly regulation is going to be effective. Well, a key thing for you to consider is the level of information that regulatory bodies, regulation-related authorities actually have. The level of information may not be perfect. We make the assumption that it's going to be perfect. That, for example, with price regulation, the level of X and K is going to be perfect. For profit regulation, that the level of profit that is allowed is going to be the perfect level. Why do we make that assumption? There is no guarantee that regulatory bodies or authorities are going to have that correct information. As a result, regulation may be too strict or maybe too lax. If it's too strict, there could be unintended consequences of firms shutting down. If it's too lax, there might still be monopoly outcomes being generated. You must consider the costs and benefits of regulation. There are significant costs of regulation, the admin costs in particular. Regulatory bodies employ lots of different people, and the taxpayer is the one that pays for these very expensive authorities to exist. There are significant costs of regulation, and there are not necessarily high benefits, especially if regulation is too strict or it's too lax, in which case the cost may exceed the benefits and we get to government failure, a very strong argument. Don't forget the regulatory capture argument. This maybe is one of the biggest problems of monopoly regulation, one of the biggest risks. All of these three evaluation points lead to government failure, where the costs of intervention outweigh the benefits of intervention. A very strong argument to make. You've also got to consider that there are some benefits of monopoly, aren't there? And if we regulate monopolies too harshly, we might lose some of those benefits, such as the dynamic efficiency of benefits, the dynamic efficiency of monopolies, such as the natural monopoly. And we know that if a natural monopoly exists, then promoting competition is not a good thing. There'll be a wasteful duplication of resources and allocative inefficiency in that case. So you don't want to regulate so harshly where you lose the benefits of monopoly as well. So that covers this very important topic area, guys. Often you'll see big questions on this in your exam. So hopefully now you're taking down your notes, you feel very confident with the material, and you can smash an essay on this topic. Thank you so much for watching, guys. I'll see you all in the next video.